We have officially entered the event horizon. For months, we warned that the silver market was trading on borrowed time. We warned that the paper price in New York was a fiction, a digital illusion maintained by algorithms that were increasingly divorced from physical reality. We warned that when the dam finally broke, the water wouldn't just flow, it would crash. Today, Monday, January 12, 2026, the dam didn't just crack, it disintegrated. Look at the chart. Do not just glance at it, study it. The price of silver on the COMEX touched an all-time high of $84 in the early session. It is currently battling around $82.79. That is a move of nearly 4% in a single trading session. But if you only look at the New York price, you are missing the single most important data point of the day. You are missing the number that explains why the banks have lost control. While Wall Street is staring at $82, looking for resistance, looking for a double top, looking for an excuse to sell, the Shanghai Gold Exchange just fixed the price of silver at $91.13. Let me repeat that number because it is the most critical number in the global financial system right now. $91.13. There is now a $7 spread between the price of silver in the West and the price of silver in the East. This is not an arbitrage opportunity. This is a structural fracture. This is the physical market in Asia, screaming that the paper market in New York is insolvent. When you see a gap of this magnitude, you are witnessing the death of a pricing mechanism. The COMEX is trying to tell you silver is worth $82. The physical buyers in Shanghai are paying $91. Who is right? The market with the paper leverage or the market with the physical delivery? Physics always wins. The price in New York has to move up to meet Shanghai. It has no choice. If it stays at $82, every trader on the planet will buy in New York and sell in Shanghai until the vaults in the West are empty. This is the mechanism that forces the squeeze. So let's dissect the price action we saw this morning. We opened the session at $80.69. We dipped to a low of $79.95, and then the vacuum opened. The price teleported to $84. This vertical move is exactly what we saw in the nickel market in March of 2022. Do you remember that? A massive commercial short seller got caught on the wrong side of a geopolitical shift. The price went vertical. The exchange broke. The trades were canceled. We are seeing the early stages of that exact same pattern in silver. The vertical green line on today's chart is a crime scene. It is the footprint of a forced buyer. Somewhere in the plumbing of the financial system, a massive entity, likely a bullion bank or a major industrial hedging fund, ran out of collateral. They were short at $75. When the Shanghai price hit $91, their risk model blew up. The clearinghouse computer took over and hit the market. Buy order. It bought at 81. It bought at 82. It bought at 83. It did not stop buying until it hit $84. But we must remain rational in the face of this volatility. If you look closely at today's candle, you see a wick at the top. The price hit $84 and was pushed back down to $82.79. The mainstream media will tell you this is a rejection. They will tell you the rally is over. They will tell you that smart money is taking profits. They are lying to you. That wick is not profit. Talking gaking. That wick is desperation. It represents the last stand of the remaining short sellers. They are defending the $85 level with their lives, because they know that if silver closes above $85 while Shanghai is at $91, the game is over. They become insolvent. So, they are throwing every paper contract they have at the market. They are selling futures they do not have. They are trying to paint the chart red to scare you out of your position. But look at the result. Despite their maximum effort, despite the massive volume of selling, the candle is still green. The trend is still up. The lows are getting higher. This confirms that the suppression algorithm is broken. In December, when they smashed the price, it stayed down for a week. Today, they smash the price, and it bounces back in an hour. The law of diminishing returns has hit the manipulation desk. We need to talk about the Monday morning gap. Gapping up through an all-time high on a Monday is a very specific technical signal. It means the news, the Shanghai price, the industrial shortages, accumulated over the weekend. The pressure built up while the markets were closed. And the moment the bell rang, the pressure released. This creates a psychological crisis for everyone who is sitting in cash. If you are waiting for a pullback to $75 to buy, you're now realizing that pullback might never come. You're looking at $83 and feeling the fear of missing out. This fear is what drives the next leg of the rally. It is called a chase. Funds that are underweight silver are forced to chase the price higher because they cannot afford to underperform the benchmark. But I want to give you a warning. In a vertical market, volatility is the weapon of choice for the banks. They cannot stop the price from going up, but they can make the ride incredibly painful. It is highly probable that we see a flush later this week. They might manage to drive the price back down to test $79. If you see silver drop $5 tomorrow, do not panic. Do not sell your physical metal. A drop to $79 would simply be a back test of the breakout level. It is the market checking to see if the floor is solid, it is healthy, it is normal. However, given the Shanghai premium of $7, there is a very real possibility that the back test never happens. We might just keep going, and we might see limit up days where the exchange halts trading because the price is moving too fast, or you have to change your mindset. You're no longer trading a range. You're surviving a currency reset. When you see silver at $84, do not think silver is expensive. Think the dollar is broken. You're watching the purchasing power of the fiat currency evaporate in real time. The chart of silver is just the inverse chart of the dollar's credibility. And right now, with Shanghai paying $91, the credibility of the COMEX pricing mechanism is zero. The disconnect between the screen price and the street price is now undeniable. If you call a dealer today to buy silver eagles, they will not sell them to you at $83. They will charge you $100, or they will tell you they're out of stock. This is what a physical default looks like. The price on the screen is for paper. The price on the street is for metal, and the spread between them is widening every single day. So, as we close out this first part of the analysis, the technical verdict is clear. The trend has changed from accumulation to vertical liquidation. We have broken the $80 ceiling. We have touched $84, and we have a massive magnet at $91 pulling us higher. The banks are fighting a losing battle. They are trying to hold a beach ball underwater with a toothpick. They might win a few minutes of price action. They might paint a red candle on the hourly chart. But the physics of the market, the arbitrage between East and West, is relentless. In the next section of this deep dive, we are going to look at the industrial panic. We are going to explain why companies like Samsung and Tesla do not care about the price. They care about supply. And we're going to show you why their panic buying creates a floor under the price that no banker can smash through. The paper game ended on Sunday night. The physical game began on Monday morning, and the score is currently Shanghai 91, New York 82. The gap must close, and it will close to the upside. While the algorithms in New York were fighting over the price of a paper contract, a very different and much more terrifying conversation was happening in the boardrooms of the world's largest manufacturing conglomerates. We have spoken at length about the paper game versus the physics game. Today on January 12th, the players of the physics game just flipped the table. To understand why silver is not crashing back to $60, why the $84 level is acting as a magnet rather than a ceiling, you have to put yourself in the shoes of a procurement officer at Samsung SDI or Tesla. You are not a day trader. You do not care about Fibonacci retracements or moving averages. You have one job. Ensure that the assembly line does not stop. We know from our previous investigations that Samsung has committed billions of dollars to the mass production of solid-state batteries. These batteries utilize a silver-carbon nanocomposite anode